Hello and welcome everyone to this new edition of the PPP loan overview with Erica Horn and John Wurtenberger at Dean Dorton. We are so happy that everyone can join us today. Just a couple of housekeeping items. I want to let everyone know that we are recording this presentation and we will be sending that out afterwards. And if you have any questions, I know there's going to be a lot of them and we're excited to answer as many as we can. So please send all chat questions through the chat feature in WebEx. It is at the bottom right of your screen, and we will be monitoring that throughout. But with that being said, I would like to introduce John Wurtenberger and Erica Horn, who will be doing the presentation today. So take it away, Erica and John.
Here we go. Well, everyone, welcome on this dreary Tuesday lunchtime for PPP2, an overview. Oh, gosh, John, it rhymes. I didn't realize that. How lucky are we? John and I are here today. I think you probably know both of us by now if you've been on our prior PPP webinars. I am a 30-plus year business person with a background in law and accounting. My specific expertise when I'm not playing PPP loan person is state and local taxes, state income, property, sales and use, blah, 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 you name it, state does it, I play in it. For corporations, all businesses actually, small and large. I think I volunteered, John, as did you, for this PPP detail when it came out in the beginning, which is something to rethink every now and again. Please go ahead and start sending us your questions.
In the previous aid package, those who took PPP were ineligible to take the retention tax credit. So if we were ineligible for the first round in 2020, can we take the tax credit for that period since we got no help, then take the PPP2 and not the credit now that we are eligible?
I think the answer to that is yes. The prohibition for getting both a PPP loan and a employee retention credit was eliminated. The actual prohibition was eliminated. There is some interplay where the statute tries to keep you from doubling up on using the same wages for both programs. So we're not going to go into those details today, but we do have an article and we can shoot it to you about the employee retention credits that Maddie Schuler, our employee family/sick leave credit specialist, put out earlier. So we'll put that link in the email where we follow up and send you the slides as well. So, John, you were getting ready to tell us about John.
Yeah, I was, and I apologize for the audio difficulty there. It wouldn't be a webinar without some, so we went ahead and got it out of the way at the beginning. But as Erica mentioned, I'm an assurance director with Dean Dorton, and Erica and I both have been a part of the COVID-19 team here at Dean Dorton since the CARES Act was enacted back in March of 2020, which Erica seems crazy that, in just a couple of months, we're going to be coming up on a year. I think when both of us started in and kind of volunteered ourselves for the CARES Act and PPP loans, I can honestly say that, I thought it would be a few months and that would be it. And, it'd get us through the summer. And then now here we are sitting in 2021 talking about a brand new program related to Paycheck Protection loans and how that may look once new guidance is released. So I'm based out of Louisville, Kentucky. Aside from doing CARES Act and PPP stuff, I also assist in the assurance practice, performing compliance services such as audits, reviews, compilations, consulting with our clients, helping out from a business advisory perspective. So that's my normal job, what I was hired to do. But right now, a large part of my past year has been made up of PPP loans. So that's a little bit about us. And I think, Erica, I came in on that question. I think it was about the employee retention tax credits. I think an important part about that, as everybody thinks through it, is that it's clear that they've made the credits eligible for those that received a Paycheck Protection loan. Exactly how that's going to look and it be applied in practice, there's a lot of questions on right now. For example, if you've applied for forgiveness, what are the wages that you put on your forgiveness application for Paycheck Protection loans? How are those going to play into the qualified wages for the employee retention credit? How are they going to maybe pause anybody who submitted a forgiveness application if you want to go back and then use some of those wages for the employee retention credit? How this is going to be put in practice, I think there's still some questions out there. So I think the main answer is yes, people are eligible to do both, but how to do that, it remains yet to be seen.
Yeah. So not a webinar without a disclaimer that you can't trust us. There's a guy who writes articles for forums named Anthony Nitty or Tony Nitty, and he's written a lot about PPP loans, and he said every time he tries to predict something, he's wrong, and he doesn't know why people read his articles anymore. But it just goes to something that John and I want to emphasize today, and that is we think we should take it a little slower this time and see what guidance we get from SBA, and hopefully we won't be flying the airplane and building it at the same time, but they'll actually give us some building blocks, and we'll be able to go from there. So overall today, we're going to briefly talk about an overview of the bill, the big picture. PPP round one, what's new? We've already got our first question. John, can first-time PPP applicants, do you have to meet the gross receipts test? And then we'll talk about second draw loans, or PPP round two. We'll talk about economic injury disaster loan advances, also known as grants or EIDL advances. And we've started a list of questions. And we're interested in you all adding to that list. So let's see about that bill, John.
Yeah, Erica, and just from a question standpoint, if we didn't already cover it, we'll try to get to some questions throughout the process, but we'll hold a lot of those till the end. Just to, I guess, quickly answer the question that you already brought up, Erica, if you're in the bucket of a borrower who did not receive a Paycheck Protection round one loan, and you want to go back and apply for one once they open that back up, that decline in gross receipts is not an eligibility criteria that you have to meet for a round one loan. That decline in gross receipts or revenue is specific to second draw loans only.
Thank you. So this package, known, as you see there, as the Economic Aid to Hard-Hit Small Businesses, Nonprofits, and Venues Act, it is a subsection of the Consolidated Appropriations Act of 2021. You may have heard that it was over 5,000 pages, and in the original form that it came out in, it was, as signed by the president and added to the annals of legislation. It's 2,124 pages because it's single-spaced and really squinchy type. There are the sections related to the PPP loans start around page 812 and continue to about 870 or 871. It doesn't sound like that much, but if you try to read it, you'll understand quickly that it says things like Section 7A 36F Little Roman numeral 1 of the Small Business Act, 15 U.S.C. 636, strike, subclause, blah-de-blah, and insert, blah-de-blah. So it gets to be really kind of tedious, maybe. we've highlighted here some changes to the round 1, 304 through 310. The second draw loans are in section 311 primarily. There are changes to forgiveness as well. There are lots of other provisions in this bill, provisions related to the employee retention credit, like we were talking about a minute ago, technical tax changes, and also other programs for everything from shuttered venues to additional transportation provisions, education provisions, et cetera, et cetera. So, John, with all of that, how about what's new? And is there anything that's the same, or do we know?
Yeah, I think reading between the lines when you get into the new bill text and comparing it to what's out there already related to round 1, you can almost make an assumption that if there's not something that's specifically stated in the new bill, that it's going to be the same as the program terms for round 1 loans. However, we all know what that gets you when you start making assumptions, especially when it relates to Paycheck Protection Program loans. So stuff like affiliate considerations, the types of allowable and forgivable uses when you think about payroll costs and utilities, rent, that type of stuff, we expect that to remain consistent between, the new bill and what was originally out there with the Paycheck Protection Program loans, but with the caveat, and that's a big but, around let's wait until there's new guidance and they open up PPP round 1 again to fully understand if there's going to be changes made to the round 1 program beyond what we know of in the new bill. One of the things in the disclaimer section, Erica, that you already mentioned, and I'm sure many people are aware of on the webinar, but when the CARES Act was initially enacted back in March, what was in that CARES Act and what actually ended up being in practice for the Paycheck Protection Program loans was drastically different in many circumstances. So we take everything in this bill with a grain of salt. And we realize that it's subject to change once new guidance comes out but from the SBA. So we're really going to go over kind of what's in the bill right now and what we know, and then what we don't know, we're going to wait until we see additional guidance. So that's the first point, really, what's new for round 1. The SBA within the bill numerous times, not only with PPP round 1, but as you'll see kind of throughout our slides, there's directions for the administrator to come out with new regulations for the programs or the different revisions within the bill, and it gives a time frame for the administrator to do so. And I think it's important to keep in mind that timeline, I think, Erica, correct me if I'm wrong, is not a deadline, but more meant to as a guideline for when they should come out with regulations. So they technically, for the changes to PPP round 1, they are provided the guidance to come out within 10 days, which would be tomorrow. But that deadline could definitely not hold true, and it could be later than that. Is that correct, Erica?
Yeah, so I'm sure if you ask your average congressperson, did you enact a date that you think of as a suggestion, or did you mean it? They would say, we mean it. I think that at one point in time, SBA took the position that they considered the deadlines, guidance, or suggestions. I don't think most strict constructionists of statutes would agree with that. But, and especially today, John, it's strange times where we're between presidents. That means we're between, administrations and appointments and all of those things. We had the holidays, which a lot of people spent working on this program, and perhaps the people at SBA did too. So I'm a little concerned. They've got a lot of deadlines to meet in a very short amount of time. I really hope they do. Needless to say, but just don't bet any money on the dates is what I'm saying.
Yeah. I think that's fair, and that's probably going to be true, Erica. So we'll wait and see when the new guidance comes out, but we'll continue to monitor that and then push out information once we have an ability to digest it and get it out to everybody through emails, other webinars. that sort of stuff. The program end date was extended to March 31st, 2021. So if you recall, the last date to apply for a Paycheck Protection Program Round 1 loan was back in August 8th, I think is when they closed the window. And the program hasn't been open to new applicants since then. So we don't know exactly when it's going to reopen, but the end date has been extended to March 31st, 2021. We mentioned some of the stuff that's remained the same and some of the stuff that's changed. The new borrower eligibility brought in new types of organizations that can now apply for a Paycheck Protection Program Round 1 loan. Those existing types of borrowers, when you think about business concerns, including small business concerns, veteran organizations, tribal organizations, nonprofits that have always been eligible for a Paycheck Protection Program Round 1 loan, those entities are still eligible to the extent that they haven't already received a loan, but this new bill expands the borrower eligibility and brings in these housing cooperatives, these destination marketing organizations, 501c6 organizations, and then also news organizations. So when you get into those different organizations that are now eligible, there's very detailed criteria and definitions of what those organizations are. So if you have questions about, hey, I'm a news organization, but I'm not sure that I qualify, I think it's important to reach out and let us help you kind of digest that information and see if you would meet the criteria. So another thing to keep in mind is that the new bill brought into eligible new borrowers, but you also have to meet the existing eligibility requirements around Paycheck Protection Round 1 loans. So you think about those 500 or fewer employees, those SBA alternative size standards around employees or revenue that you might have had to hit initially with Round 1. Those new borrowers are still going to have to hit that same criteria for Round 1 if they go and apply once the program opens back up. Another thing with ineligible entities, those have remained consistent as far as we are aware with the definition of ineligible entities from that's been in existence for Round 1 loans. The new bill did expand some of the definition around ineligible entities for second draw loans, and those include ties to China, Hong Kong, through 20% or more ownership, board of director seats, and also brought into the definition for ineligible entities those that have significant political or lobbying activities as well, and then also ones that might have taken advantage of other types of financial assistance, such as that shuttered venue grant that Erica previously mentioned. So the big thing that everybody was hoping for, and everybody was crossing their fingers and just waiting for it to happen, there were rumors about it, but it finally got included in the bill and enacted, was the tax deductibility. So when you think about the expenses that borrowers, spent their loan proceeds on, initially, those were not expected to be deductible when you go and you process your tax return for the calendar year or fiscal year 2020. Now that has been changed, and so those expenses are now deductible. And the forgiven loans, once forgiveness is actually received by the SBA received by the borrower from the SBA, that forgiven loan is not included in your gross income for tax purposes. So two important things: the expenses are now deductible, and the forgiven loans are not included in gross income for tax purposes. And then the new bill enacted that for tax years ending basically after the CARES Act was enacted back in March of 2020. So that's a big benefit for borrowers as people are looking ahead and starting to get going on their 2020 tax returns. Erica, anything else to add there or that I've covered so far?
No, you're good.
In addition, the bill also expanded eligible expenditures. So we talked about expanded eligible borrowers, but it also expanded the uses of funds that borrowers could spend the proceeds on. So when you think about what was historically allowed under the Paycheck Protection Program Round 1 loans, you think about payroll costs, utility costs, that debt interest that was an allowable use but not a forgivable use. You also think about the utilities and the interest on mortgage. In addition to those, the new bill also expanded costs that are now forgivable under Paycheck Protection Round 1 loans to include operational costs. That includes kind of technology and software used in operations to track supplies and ordering, property damage cost, which includes damage to property that wasn't covered under insurance claims that resulted from kind of civil unrest or riots, supplier costs for essential supplies, and worker protection expenses. So I'm sure many borrowers are all in the same bucket as far as that you had to incur additional expenses to purchase additional worker protection equipment, such as masks or we've all seen kind of the different barriers, the plexiglass barriers in between workstations or out in the public. So if you had any of those types of expenses related to COVID-19 worker protection equipment, those types of expenses are now forgivable costs under Round 1. So, there's very detailed definitions around each of these in the bill, and we'll include some of that detail in further publications as we put that information out. But the important thing is to also just keep in mind, we don't know how this is going to be applied in practice yet. So you would have to imagine that the SBA is going to have to go back and amend the existing loan forgiveness applications that are out there to include lines and definitions and supporting documentation that borrowers are going to have to submit for these types of costs. So the existing loan application form, and I've heard from a few different banks at this point, Erica, I don't know if you have as well, but they've actually suspended accepting their forgiveness applications just because they're aware of these changes. And if a borrower wants to go to and apply for forgiveness right now, it's really not a relevant application because of the changes that have been enacted to this bill.
Right, and the point you raised there, John, is that if you have not yet filed for forgiveness, these changes are retroactive to the start of the CARES Act. And so you could go and pick up these kinds of costs if you had them during the covered period, but you still have to meet the 60-40, 60% has to be payroll, 40% everything else. So it is helpful to have these other sorts of things, especially after the ruling on related party rent, which was harsh for small businesses, in my personal opinion. So it's nice to have these additional things, but you still have that 60-40 limit, so it still is, to some extent, payroll-oriented.
That's right. And then lastly on this slide, I'll kind of use air quotes here, newly defined covered period. So, historically with the Round 1 loans, the covered period initially was 8 weeks. With the Flexibility Act that was passed back in June of 2020, or I think that was actually July of 2020, maybe, Erica, you can correct me, but that expanded that 8 weeks to 24 weeks. And then the SBA came out with some guidance that basically said a borrower could apply for forgiveness before their 24 weeks was up, but the application really didn't change, and the application's definition of the covered period always ran out to either the end of the 8 weeks or the end of the 24 weeks. And so there was some confusion when people were going and applying for forgiveness as to, okay, well, the end date of my covered period, I'm going to put on the application of 24 weeks, that's the date, but I'm applying before the end of my 24 weeks, so I'm not including all my payroll costs in the 24 weeks. So it created some inconsistencies. And so now with the new bill, it's basically come out and said it's changed that definition of the covered period and given a borrower the ability to choose a date in between 8 weeks, the end of the 8-week period, and the end of the 24-week period as the end date of their covered period. So it's kind of eliminated those consistencies. It's given borrowers the flexibility to choose a cutoff period such that if you've spent all your loan proceeds by week 16 or by week 12, you can actually choose the end date of that period that you spent all your loan proceeds and have that be the actual end date of your covered period. Another big thing that people, talked about a lot in the fall timeframe of last year, and it was rumored in accordance with kind of the tax deductibility that we already talked about, was a simplified loan forgiveness process. And the amount kind of fluctuated a little bit. It initially was $150,000, and I think the secretary maybe came out and said $140,000, and then some people thought maybe it might be a little bit less, and then they came out with the 3508S form for $50,000 or below loans, and so everybody thought maybe that was going to be all that they were going to do. So this has moved around quite a bit, but with the new bill, that it kind of reverted back to that original rumor around the $150,000. And so essentially for borrowers that received a loan at $150,000 or less, there's a new simplified forgiveness process. And just like the changes to the PPP round 1 and the guidance that's forthcoming on that, there's a new certification, basically I'll call it application forgiveness form that's to be issued by the SBA. And again, that time frame for them to issue it was 24 days, which would approximate around January 20th. But what that's going to look like, while we don't know all the details, the bill did give some high-level overview of what that's supposed to look like when it's released. It's essentially going to be a one-page certification. The bill says that it should be no more than one page. It's going to include some general information around the loan that borrowers are going to have to fill out, the number of employees that a borrower was able to retain because of the loan proceeds, the estimated amount that they spent on payroll costs. I think estimated is a key word there. Exactly how much of an estimate, it remains to be seen. That's one of the things that hopefully will be included in the instructions with the form itself. The total loan amount, and then there's a couple certifications that the borrower just has to complete around that the information included in the loan forgiveness form is accurate, and that they've complied with the requirements that are listed within SBA Section 7A36, which just covers the Paycheck Protection Program. From a documentation standpoint, if you've attended any of our previous webinars, you know that Erica and I really like to emphasize the need for documentation and the importance of that when going and applying for forgiveness, and also retaining that documentation in accordance with the instructions that are out there for the loan forgiveness applications. The new bill actually changed those documentation requirements for the simplified loan process. So it actually specifically states that a borrower that qualifies for the simplified loan process does not need to submit any additional documentation beyond the one-page certification when applying for forgiveness. So you think about the payroll reports or the bank statements, or if you had additional costs outside of payroll, such as utilities or rent, supporting documentation associated with that. That is no longer the case with borrowers that qualify for the simplified loan process, and the documentation requirements are simply just the one-page certification. Now, on the back end, when you think about retaining documentation, it changed some of the time periods associated with that with respect to the simplified process also. So employment records need to be retained for 4 years, and then all other documentation for a period of 3 years. So if you revert back to the instructions that exist right now that are out there on the treasury.gov site, it basically instructs borrowers to retain everything for a period of 6 years. So that time period has been reduced, and it's been changed between whether it's the documentation relates to employment records or basically non-employment records. So again, that's one of the things that we'll see some clarification when the actual form and instructions comes out. And then the last thing I'll mention for this process is that they specifically did state that just because you might qualify for the simplified loan certification that's going to be coming out, that doesn't exempt you from a potential audit or review by the SBA. The SBA still has the ability to come and review any loan size at any time, and they've made that clear in the bill that those that qualify for the simplified process could still be subject to an audit or review down the road. I think the last thing that we wanted to cover over changes to round one loans before we dive into some of the second draw stuff that we know within the bill is an ability for borrowers to go back and apply for an increase in their round one loan if they've already received a round one loan and are eligible to do so. So, you're sitting there, you've received a round one loan. Am I eligible to go back and apply for an increased loan size beyond what I've already received? Well, it really applies to borrowers who initially didn't accept the full amount. So say you did your loan calculation, you went through the application process, you were going to get a loan of $1 million. For some reason, you said, I don't want $1 million. I don't think I'm going to be able to spend $1 million. I just want $750,000. So if you're in that bucket, you now have the ability to go back and apply for that difference between the two, so that extra $250,000 if that's the case. It also applies to borrowers that returned a portion of the round one loan. So maybe you didn't make the election not to receive the full amount up front, but you got the full $1 million and then subsequently said, I don't need this full amount, let me return a portion of it. You can still go back and apply now and get that difference of what you returned and what your maximum loan size was. And then there's also some IFRs, some interim final rules that are out there that actually expanded the potential loan size for certain borrowers. And those borrowers and the IFRs that are referenced in the bill apply to partnerships and seasonal businesses. So initially, when the round one loans were rolled out, a lot of stuff changed from what the guidance was at the very onset to what it ended up being, and so modifications were made throughout the time period. If you're a partnership and you're on this webinar and you're thinking back, okay, initially when I was going to apply for loans back in April of 2020, everyone told us that we couldn't include people who were self-employed or a general partner in our loan applications. Those individuals had to apply on their own individually. Well, then they came out subsequent in May of 2020 and said, no, we've thought about it, and now we want all the partnerships to include all the general partners when they're going back and applying for a loan for administrative convenience. So there's not 20 applications out there, 20 separate applications out there for partners that are all under one partnership. We want you to go and include all those partners. It also expanded the date range that seasonal businesses had the ability to use as their historical reference period to calculate their loan size. So by doing that, it may have resulted in an increased loan size from what a borrower had received in that partnership or seasonal business category. And so if you're sitting there and you think that you might have an increased loan size, the new bill provided the opportunity for those borrowers that were eligible under those interim final rules to go back and apply for an increased round one loan if they are eligible. And just like with all things that we've covered, how this is going to be put in practice and what the application process is going to look like, we don't know at this point, but there is guidance expected to be issued. And you can see that at the bottom of the slide, that guidance specific for reapplying for increases related to round one loans is expected sometime probably towards the tail end of next week, around January 13th.
John, one thing about that slide that catches my attention or about those increases is the second bullet, borrowers that returned a portion of a round one loan. I think it's fair to say that that does not include borrowers that returned a round one loan because they decided that they didn't meet the necessity certification, that the uncertain economic conditions made the loan necessary. And my friend Tom Rutledge, who's on the webinar, helped me confirm that necessity certification continues to be applicable to the new round one loans. And I think you can safely say that it would apply to second draw loans as well. So if you fall in that category, then I would, my suggestion is this was not meant for you. But those folks may not be on the call anyway, so. All right, what's next? Second draw loans. So you're on this webinar and you received a Paycheck Protection Program loan, and now you hear that if you meet certain requirements, you can get a second PPP loan. What might those requirements be? You have to have less than 300 or fewer employees. Here is part one of the biggie. You have to have a decline in gross receipts quarter over quarter of 25% or more. And you have to have received a round one loan. If you haven't, apply for round one. And then you have to show that you have or that you will, which is really interesting, use the full amount of your round one loan. So breaking that down a little bit, 300 employees, okay, we understand that, and we know that to count employees for this particular purpose, SBA treats everybody, full-time, part-time, seasonal, college work study students, everybody equals one. There are exceptions. Well, there's an exception to everything, right? So 300 employees. Now, okay, Erica, fine. Gross receipts decline of 25%. Quarterly gross receipts decline of 25%. What does quarterly mean? Does that mean any 3 months? Or does that mean a calendar quarter? What does gross receipts mean? Does that include every imaginable receipt? Does it include reimbursements of expenses? Does it include, is it equal to what you would put on your tax return? And those are all things that we simply don't know the answer to. And we await anxiously the definition of both quarterly. There's been a rumor that it'll be a calendar quarter. The law certainly reads that way because it talks about if you apply after December 31st, 2020, which of course you are now, you can use the fourth quarter of 2020 and compare that to 2019. There's some confusion about whether or not you have to meet this decline in a consecutive number of quarters, all the quarters, only one quarter. John and I were having this discussion the other day. What if you had a 75% decline in the second quarter and you rebounded and you were up 125% in the fourth? How is that interpreted? How is that going to be handled? And then we also discussed whether or not you can apply for a round one loan and a second draw basically at the same time, because the statute says will use the full amount of the round one loan, has used or will use. And then how do you prove / document for purposes of the second draw that you will use if you haven't used the full amount? What's next, John?
Yeah, and a couple, I think, key points there, Erica, just to add on to what you've already said. When you think about the gross receipts, and I think you touched on it, but we've already gotten a couple questions around, in that definition of gross receipts, what I put together for my audited financial statements under an accrual basis of accounting is different from what my internal books may be, cash basis. And so which one am I supposed to use? Do I have the flexibility? And really, there's no definition on how to calculate or how to drive this amount. I think consistency is key in this area in regards to other supporting documentation that you're going to be submitting with your application. But, until they come out with additional guidance, exactly how to calculate the gross receipts amount or the gross revenue amount and the declines remains yet to be seen. So we're just going to wait and see exactly. But right now, there's nothing that stipulates what type of method you need to use in order to calculate that. And then the has used or will use the full amount, when you think about the will use, that's on or before the date of the second draw loan originates. So you think about if you go and apply for a second draw loan and you have an outstanding PPP round one loan, well, you need to spend those PPP round one proceeds on or before that second draw loan hits your bank account. That's the way it reads right now. And so again, we'll wait and see how that that's applied in practice. but that's what that has used or will use relates to.
So we talked earlier about the 60% threshold for payroll costs. It applies to round one. It applies to the second draw as well. There is a much lower cap on the maximum amount of the loan. It's $2 million this time as opposed to $10 million. The calculation is basically the same. The time period has been shifted a little bit because now we have all of 2019 in the rearview mirror. So 2.5 times average monthly payroll costs for 2019, or a 1-year period before the loan date. So you could use a time period where you use last June through June 2020 through July 2019. Although, no, I take that back, John. You would have to use, how would you know your loan date, for one? Well, let's pretend the loan date is January 31st. That would just put you back at that would put you at calendar year 2020. Theoretically, you could have reduced payroll costs for that time period. So that's a little bit of that's not a little bit, that's a tweak. I'm not exactly sure what the ramifications of that tweak are. And then you've heard a lot of talk around the fact that Congress wanted to help folks in the restaurant industry, tourism industries. That's what these NAICS 72 entities are. Those are folks in the hospitality industry. And so they are able to borrow at 3.5 times their average monthly payroll costs, but are still capped at $2 million. There is a provision for farmers and ranchers to give around, maybe we got this in the wrong spot, but around one loan amount increase. If you're a sole proprietor, or a self-employed individual, the amount of help you've got here is not very much unless you employ other people. Otherwise, you're capped at $20,833 if it's just you, which is the amount for sole proprietors. So even though the big change here is you can use gross income, a lot of farmers and ranchers, they're called, use accelerated appreciation or take a lot of the expense deductions, and therefore they didn't have net income. They had net losses, and it locked them out of the loan. So this is allowing them to use gross receipts or gross income instead of that net income. Is a way to help them out and allow them a loan in the first place, even if it's a small loan. So that takes us to economic injury disaster loans, I think. SBA has already announced that the availability of the loans are open again. They have money again. They're extended through December 31st, 2021, or until the money runs out. SBA in the first round had 3 days to tell you whether or not you were eligible and to get you the notice, get you the money. Now they have 21 days, and they're required to tell you if you don't. It does, the act repeals loan forgiveness, the reduction of your loan forgiveness by the amount of the advance. So if you got a $300,000 economic injury disaster loan and a $10,000 advance, and you've already filled out your forgiveness application and you've received your forgiveness amount or notification, and you've been told you're going to have to pay back the $10,000 over 2 years, now you don't have to do that. What are the mechanics of that? How are you going to be relieved of that $10,000 obligation? Do y'all on the webinar remember only your hairdresser knows for sure? No one knows yet. Guidance is due shortly. It seems to me, John, it would be easy enough. SBA is the one with all this information. So it seems it would be easy enough for SBA to issue a series of notices, letters, whatever, that says your $10,000 is now forgiven. You don't have any obligation to the bank. But as with all nuts and bolts things, how to apply for an increase, when to apply for round 2 or second draw, how to get this last $10,000 forgiven, all those nuts and bolts things are in the air until we get some forms and whatnot from SBA.
That's right. So I know there's been, Erica, a lot of questions that have come through the chat, and we've actually, touched on a few of the questions that Erica, you and I and the rest of our COVID-19 team have as we've, had an opportunity to read through the bill and kind of digest some of the changes associated with it. And we've touched on some of these already, Erica, when you think about the quarterly receipts decline that we talked about, exactly how is that going to be, calculated, what method borrowers need to use when doing so. The timing, we talked about that a little bit, the timing for PPP-1 and round 2 and then round 1 increases. You think about the end date for the programs being March 31st, 2021. Does a borrower have the ability to apply for a round 1 loan if they didn't get a round 1 loan and then spend all those proceeds within that time period, now that we're January 5th through March 31st, spend all those proceeds, apply for a round 2, get a round 2 before the end date? I think that, how exactly that's going to work from just an 8-week covered period, a 24-week covered period, that kind of remains to be seen. So that's a question that we have out there. And then the proof of spending round 1 proceeds, you already talked about that, Erica. Is that going to be, an actual one of those things that a borrower needs to submit supporting documentation for when applying for around a second draw loan that they've actually spent or will spend? I think it's going to be really hard for a borrower to put some support around they will spend round 1 proceeds by the date that they get the round 2 proceeds. So maybe that's just going to be a good faith certification. I don't know. Within the application itself, that kind of remains to be seen. And then the documentation for the expanded forgivable costs too, when you think about kind of those operational costs, those worker protection costs, supplier costs that we talked about previously for both round 1 and round 2 loans, what's that documentation going to look like? We can glean off kind of what is in the application forms themselves right now and say, it says account statements, bank statements, that type of stuff. So we can expect it to be something around those lines, but we don't know exactly what that's going to be yet.
Yeah. So some of the questions that we haven't covered, John, includes will banks require some level of assurance on the decline, the drop in revenue? And actually, for loans $150,000 or under, you only have to certify up front that you had that decline, but you have to submit documentation showing that you did on the back end.
When you're applying for forgiveness, right? On the back end, when applying for forgiveness, yes. You need to. Yeah. Yes,
that's when you have to demonstrate that. Lenders are simply required on that back end, just again, $150,000 and under. So if you're over that, if you're seeking a loan over that amount, then you probably will have to produce something. The banks are able to, whatever you produce, they're able to rely on, but they need to check a box saying, yep, they produced something, and it looks like more than 25% to us. 501c6 organizations, who are they? Any 501c6 subject to certain lobbying limitations. So if lobbying makes up X percent of your cost, or if lobbying makes up part of your business model is related to lobbying, then you can't apply. They're specific
as well
about
as meet the employee thresholds too, right, Erica?
Yes. All of that, all of the regular requirements, plus limitations related to lobbying. Someone yeah, I mean, there are a lot of C6s that have suffered a lot of damage, and a lot of them fall in that destination marketing organization too, John. So if you have an S corporation that had a PPP1 loan, someone asked whether or not there would be changes to the shareholders' basis as a result of the lack of taxability of the income and the being able to to deduct the expenses, and the answer to that is no. The statute says that there won't be any changes for S Corp or others related to their basis as a result of the tax treatment of these items. If your PPP hasn't been forgiven, John, do you think you're going to have to do it over again because the forms are out of date? You've already submitted your application, but now the form's out of date?
I don't know that. Yeah, I think it depends on your specific situation, and this is probably just me, taking a guess at this point. But if you have enough eligible expenses under your application that's been submitted, and you're able to achieve full forgiveness, my guess is that you're not going to have to redo that application just to comply with the new the new changes that have now been pushed through. But it kind of remains to be seen. I don't know. For somebody who has applied for forgiveness and maybe didn't have enough cost to achieve full forgiveness, or had a reduction, or applied for forgiveness and then had that EIDL advance amount that was initially on there, you have to think that there's going to be some way for that borrower to amend that application or go back and include additional costs that are now eligible and forgivable expenses to try and achieve full forgiveness. I just don't know exactly how the banks are going to push pause on that process and how the SBA is going to push pause on that process to allow time for that to occur.
Yeah, I don't think you have to have applied for forgiveness. An unrelated, but speaking of forgiveness question, to get a second draw because of the language saying that you can prove you will use all the funds. Certainly showing your forgiveness application and that you've submitted it is the best proof that you spent all your funds, perhaps. Does the gross receipts decline for not-for-profit organizations include charitable contributions? I don't know. So there is a definition of gross receipts in the statute for nonprofit organizations that I haven't, despite having tried since last week, digested that or come to a point yet where I know what the answer to that is. I don't also know, another question here is, when is the final guidance expected to be issued regarding the 25%? John, I don't remember seeing a date on that one. And if there was a date, then we included it. So,
I'm going back to
I'm not sure about that. Yeah.
Yeah, that would be under the second draw loans.
On the second draw, is that where they have 24 days? I would anticipate, we don't have a date. Obviously, Congress intended for this money to go out sooner rather than later. Again, subject to whatever human limitations that they have and whatever limitations arise as a result of the transition between administrations. Hopefully that information comes quickly. John, we're out of time. You want to wrap it up?
Yeah, I don't have access to the chat.
Oh, we
so
got 5 minutes. So we actually got quite a few questions, and I know we will not have time to get through all of them. So I do want to make sure everyone knows that we will be writing all of them down, and we will be addressing as many as we can outside of the webinar. But first, let's go
Careful
with this
what you
question.
promise, Julia.
This is true. This is true. I am. I am just a webinar worker. I do not have all the answers. But do we have to have maintained personnel levels consistent through 2020 in order to achieve second draw?
I don't, I mean, the only eligibility requirement around second draw loans related to employees is going to be that 300 employee headcount level. So I don't think that at this point that relates to any, maintaining headcount throughout 2020, that 300 employee headcount has to be what you maintain throughout 2020 to qualify. Similar to the initial application, Erica, do you think that's correct when we're thinking about the 500 employee threshold for round one loans?
Yeah, I think I think the second draw is all about the gross receipts, whatever that means. And as a business person, if you had a decline in gross receipts of 25% or more, I would question how you did maintain your payroll or all of your employees. So I have not seen that that's an issue.
As far as gross receipts, I assume we do not need to include the PPP-1 loan, even if it is forgiven.
I would expect that not to be a factor in the gross receipts calculation when you're looking at a potential decline of 25% or more.
Yeah. I think I've read other commentators say that as if it's a definitive. It's not in the statute, but I have a hard time believing that they would. That's not, well, it is the government. I was going to say that's not fair.
Right.
But, yeah, I don't expect that to be included.
Are there any advantages, such as moving to the front of the line if the business is located in a low-income area? There
are certain amounts of money set aside for borrowers in low-income communities, and that is a defined term. There are also targeted economic injury disaster loans for borrowers in low-income communities. So there should be an advantage. Yes, I don't know that it moves you to the front of the line, but there should be an advantage.
Yeah, that is one of the things too, Erica, that I think the administrator was supposed to issue guidance on, and that's supposed to be within 10 days. So I think that kind of coincides with tomorrow's date and it was really the ability to access capital is what that guidance was supposed to address. And so that kind of is one of those things that we're just waiting to see what that guidance specifically will say.
Any PPP2 eligibility if you were not in business in 2019?
If you weren't in business in 2019, go ahead.
You have to have been in business as of February 15th, 2020. And then the calculation of the loan amount varies depending on when you were in business.
Yeah, and I would remember that if you're going to go second draw loan, you need to make sure that you've taken advantage of a round one loan first.
I think we have time for just one last question, and this is an easy one. When can you start to apply for the round two loans?
Well, why do you say that's easy? I like to harass the hosts. So I don't know. We don't know. As soon as SBA makes an application available, it's part one. And as soon as banks will accept them, it's part two.
If anybody knows the answer, go ahead and put your lottery numbers in the chat, and then we'll just all play those. Well, one thing really quick, I think I saw a chat come through. They pop up very briefly on my screen about what I said earlier about the tax deductibility, Erica, and the forgiven loans not being included in gross income. When I said that, I meant that to be for tax purposes only. So it's not going to be included in gross income for your tax return only, when you think about your book income on your financial statements and when you go and have your audit or review performed, you do have the ability to recognize that forgiven loan in your income statement as other income even before it actually gets formally forgiven. So the accounting side and the tax side are two separate things there. I was specifically referencing the tax recognition of income under that slide. So, Erica, any final thoughts?
I just wish everyone Happy New Year, Happy New PPP year. Thank you very much for joining us today. We appreciate that. And we appreciate the opportunity to be of service both to our clients, our teacher clients, and our community.
Yeah, please let us know if there's additional questions. Reach out to Erica and I. Our contact information is right here on this last slide. We're happy to answer any questions, and then, as new guidance gets released, we will push that out and get that disseminated to everybody as quickly as we can. So thank you all again for the time. Appreciate it.
Thanks very much.